Hi everyone, Linda Makateni here and welcome back to the Finance for Families channel. Today we want to have a look at the recent bond offering from EABL, East African Breweries. They are in the market for a 5-year bond, and we just want to go through the key details of this bond before, as retail investors, we decide whether it is worthy of our investment, because we always want to make investments from an informed point of view. So we start off the issuer, that is East African Breweries. What they're looking for is up to 20 billion shillings, but they're going to do this via several issuances. So for this first issuance, they are looking for up to 11 billion shillings, right? So the tenor of this is 5 years, which basically means you're lending the money to East African Breweries for 5 years, after which, on maturity, they will pay you back the principal. This is the money that you have invested. The interest rate they're offering is fixed at 11.8%, meaning each year you will be paid interest equal to 11.8% of the amount you have invested up to maturity. Minimum subscription amount is 10,000 shillings and increments of 10,000. So you cannot come in to invest 15,000, but you can invest 20, you can invest 30, that in multiples of 10,000. Yeah. So the status of the debt, and this is very important here, the notes are unsecured and will rank pari passu with all unsecured debt of the issuer. Now, this means that it has the same claim priority as other unsecured creditors of EABL. So in a situation where EABL faces financial problems, unsecured creditors get paid after secured creditors. Yeah. Very important point to note. Then there is the listing. So the bond is going to be listed on the Nairobi Securities Exchange. So once invested, you can be able to sell it on the secondary market via trading on the exchange. Yeah. What else have they given us? So they've given us the dates for the offering. It's already open. The offer closes on the 10th of November. You'll get confirmation of your allotment on 12th of November. And you have to make payment by the 18th of November, and then it's going to be updated onto your CDS, meaning now that is when you'll be able to say officially an EABL bond investor on the 20th. Now, I just want us to have a look at some of the features of this bond. The 11.8% fixed interest rate is attractive compared to what is currently in the market now in terms of investments. We know the bond, the interest rates have gone down, and when you're looking at where to invest, this might look like a good option. The 5-year term means that for the next 5 years there is a fixed return that you will be getting. That is assuming everything goes well and EABL is able to pay on time. The minimum investment of 10,000 makes it very accessible for retail investors like you and I. Then being listed on the exchange also means that you have at least that possibility of being able to sell in case you would want to within that 5-year period. Yeah. Now, there are risks. Yes, we look at the rewards, the good attributes of it, but we also need to understand the risks when we are making our decision. So one, we spoke about it being unsecured. The risk is higher than secured debt. So if the company runs into trouble, other creditors with security will be paid first. We really need to take note of that. When it comes to understanding whether the rate being offered, the 11.8% for this EABL bond, is good enough, and does it truly reflect the risk premium, we need to understand what risk premium is. Now, risk premium is that extra reward as an investor you expect for taking on extra risk. When you're lending money to someone, in this case East African Breweries, because we are lending money to them, you want to be paid for two things. One is the use of your money, and that's like the basic interest rate that you will be given for that. And the second one is the risk that you might not get your money back. That's the risk premium. So the riskier the borrower, the instances, the higher the risk that they may not pay you back, the higher the premium should be. So when you think about it, government bonds are considered low risk because the government is seen as the most reliable borrower. It can raise taxes, it can print money so that they can be able to pay you back. Compared to corporates like EABL, theirs are riskier because companies can face challenges, declining profits, higher costs, market shocks that affect their ability to pay interest or return your principal on time. Now, because of that risk that corporates have, they have to compensate for it. That difference in return between the corporate bond and the government bond for the same period is what is the premium, the risk premium. Yeah. So if you think about it, currently government bonds for the same tenor, 5 years, are about between 11 and 11.5. And here is EABL offering 11.8. So the question is that extra return for taking EABL's corporate risk, that 0.5%, is it really worth it? Considering the bond is unsecured and it's a corporate bond, and then there's also inflation and interest rate changes that will affect your real return within this period. Yeah. So really important to think through that. The other risk as well is liquidity risk. Though it's listed, the secondary market when it comes to corporate bonds is heavily skewed. Actually, in just bonds in general, is still heavily skewed towards the is heavily skewed towards volume, and this means it might just be a bit hard for you to be able to sell and at a good price when you eventually want to sell. There's also the interest rate risk that you have to consider. This is in cases where the interest rate does go up, then the value of your bond on the secondary market falls. Yeah, because then people will be looking, why should I buy your bond at that rate? Meanwhile, I can go and buy a bond in the primary issue for a better rate. Then we've talked about credit risks, the company that needs to be factored in, where we are thinking how stable is EABL's ability to pay interest and also pay you back the principal when it's due. That is looking at their overall financial health, at least because it is a listed company. That one, or from my analysis, it is a stable company. But these are some of the risks that you also have to think about, even as you're looking at the rewards that will come with you investing in this bond. So bottom line for a beginner investor is, if I'm looking to invest, one, do I have the money? Do I have either 10,000 minimum, or do I have enough that is in increments of 10,000? Am I okay with 11.8% for 5 years? Then you're just looking to see, am I also able, for me this is very key because we've talked about the liquidity aspect, am I also able to hold on to this bond if need be for the duration of this bond? So those are some of the considerations. I do hope it does help you to make a better decision as to whether to invest in this bond or not. And looking forward to hearing your comments. Let's talk about it. Let's talk about this in the comments. Thank you, and see you in the next video.